Liquidity trading is one of the most complicated trading systems in the market, but yet, understanding how liquidity concepts works will place you above 90% of traders that don't understand these high-profit liquidity trading strategies. These strategies will make you incredibly rich in the market. If you can identify where the liquidity sits in a market, you will basically understand the magnetic areas that the market price is going to be attracted to. And that means that you can be able to take great trades with clear targets and even identify great reversal points on the chart. And most importantly, you will be able to avoid taking a lot of losses that the market usually traps you with when you did not understand liquidity. In this video, I'm going to simplify everything and guide you into the basics of liquidity concepts, the forms of liquidity that you must know, and the liquidity concept trading strategies that you can begin to use now to make high profits every day from the market. Now, my tribe soldiers, let's get down into the business. First off, what is liquidity? In the simplest form possible, liquidity refers to orders or money markets moves based on the flow of orders. So when there's more buying than selling, the markets goes up, and when there's more selling than buying, the markets will start going down. In order for a significant buying or selling moves to happen, the market needs to come into an area with a significant number of orders where the market will trade freely through ranges because no one is buying or selling in the middle of the ranges. But if they are, it will be happening in very small numbers. But when we sweep swing lows and swing highs, you will begin to see the market forming significant reversals like the one down here and this one up here. The reason why this happens is because above the swing highs and below the swing lows, there is a lot of liquidity or orders. Anyone selling from here is likely to have a stop loss over the swing high, and they will also be taking profits somewhere down here. And anyone who bought down here will possibly have their stop loss here and will likely be taking profits somewhere here. So when the market reaches these areas of take profits, stop losses, sell stops, or buy stops, there is a whole load of orders there for the market to react to. And this is what actually causes these reversals and reactions to occur in the market. So liquidity in the context of a market is simply orders at highs and lows and around different ranges, which the market comes into and then reacts from there. There are three ways that we can identify liquidity clearly, so that we can start to use it to our advantage without lots of confusion. And these three forms of liquidity are: number one, equal high and equal low liquidity. I pair these two together because they're practically the same. And then we have the trend liquidity and the range liquidity. Now, the most common forms of liquidity that you will see, and the easiest to actually identify and trade, are equal high and equal low liquidity. For this video, I want you to put your full focus on these two, and then obviously taking the information I will give you on the other ones. But this one will be the foundation of your liquidity trading. So like I said earlier, the markets always react to orders. So our major goal when identifying liquidity is to determine where the majority of the orders are going to be placed in the market. In the context of equal high or equal low liquidity, we are essentially looking at resistance or support, because we have either equal highs, which is a resistance level, or equal lows, which is a support level. And one of the basic trading education, which a lot of traders are still working with, suggests that when you have a resistance, you put a stop loss above the high. So based on that perspective, we know that there is going to be a lot of stop losses above equal high levels. And also, many traders put a stop loss below the support if they buy at a support level, which means there's going to be a lot of liquidity underneath equal lows and a lot of liquidity above the equal highs. Now, we also have additional forms of liquidity. We may have traders looking to buy at breakout levels if the market was to push above a level, which means we will have an extra layer of liquidity here in the form of buy stops for breakout traders who are expecting to buy if the market breaks out. The same goes for support floors or equal low liquidity, we will have sell stops here from traders who are looking to sell. Once the market breaks these equal lows, so what the support or resistance actually does here is formulate a lot of liquidity or orders above or below the level, which means we can use equal lows or equal highs for two different things. Number one, we can use them as solid targets. For example, if we found a buying opportunity in the market here, we could use the equal highs as a target, because we know the market is very likely to trade back towards these equal highs and trade through into the liquidity. The same goes for the sell side. If we have a pool of liquidity down here, it's likely that the market will trade into it. So if we use this area as a target for a sell trade, that would be a high probability target with a pretty high chance of being filled. But the more interesting thing about liquidity is not just using it for targets, but actually the consideration of trade entries. Now, when we see an equal high liquidity, for example, we know this is a resistance, so a lot of traders will be looking to sell here. Now, the first thing you should do is to wait and not join them. Don't join traders in selling equal highs. If you see equal highs in the market, the last thing you want to do is to try and sell the trade, because it's likely that the market is going to push through in order to react to the liquidity. This is where the term stop loss hunts came from. Because the sellers sell at resistance, they have stop losses above, and the markets always go hunting their stop loss by trading through that level, and then it moves in the right direction without the traders who sold at the resistance, because they have now been stopped out. That is the market reacting to the orders at that level. We need large amount of transactions in order to get significant reversals. We know there is a huge amount of transactions waiting to be taken up here. Now all of these sellers will have to buy back contracts for their loss, which will now provide a lot of buy liquidity, of which a smart trader can then sell to. So if you had a massive amount of money and you wanted to get into a position and you could not get in one certain level without moving the market, what you should do instead is wait for the market to trade into an area of liquidity, and when all of these sellers have to buy back, you can then jump into the other side of their trade and sell the market on them. This is where the context of institutional versus retail traders comes. Retail traders, such as everyday traders, like me and you, we only make up around 5% of the market trading volume. The other 95% is from institutional trading participants with huge sums of money to trade with. And these instructional traders can't always get into a trade straight away, so they need to reach for areas of liquidity in order to get into positions. That is why, once the liquidity is filled, we get these more significant movements, because it's a large influx of money into the market, and this happens either on the sell or the buy side. Now the question is, how can you use all this to your advantage and start moving like the 95% institutional traders who takes huge advantage of liquidity? Well, first of all, don't sell immediately at resistance levels, and don't buy immediately at support levels, because if you do, you're likely to get stopped out on a stop hunt before the market starts moving in the right direction. And secondly, we can actually use this sweep of liquidity, as we would call it, to get into positions. And the same thing goes for equal lows. We can use them as targets, but more importantly, we can avoid buying immediately at these support floor, because we know there's a lot of liquidity below. And number two, we can actually use the sweep of the liquidity and the sweep of the support floor to get into positions. So equal high and equal low liquidity is good for targets, getting into positions and avoiding silly losses. Now, let me show you an example of this on the chart. So on this chart right now, when you look well into it, what are the things that you see? Well, on this side, you can see that the first thing you will notice from a liquidity perspective is this collection of equal lows. So we have an area here which acts as unclear support, and here the market is trading into this level and pushing away multiple times, and this formulates the equal lows. Now, if we know that there are buyers buying this support floor. We also then know that there is going to be stop losses or orders, and potentially even sell stops for breakout traders, which will be sitting below this equal low level, becoming an area of liquidity. Now, how do we use this to our own advantage? Well, as we just said, number one, we avoid buying once again when the market comes down to this level, and instead we wait for a sweep of this level here, where we could expect the market to start rising up, because we will react to the orders and transactions that are waiting under this level. Now we know, because there's not going to be a lot of orders in the middle of the range, because most people are buying and selling, or looking for breakout positions from the swing highs and swing lows in the market. There's not going to be much resistance here in the way of buying. So number one, we could potentially take a trade if we found a selling opportunity using these equal lows and also using this support floor as a target for any short positions. And then once the market reaches this area, we can anticipate that a reversal could likely happen from underneath, because we will have swept an area of liquidity, and the market could then react to those transactions and start moving in the other direction. Now, there's one more thing that you should take notice of on this chart. But hey, don't worry. When you go through the charts, you will start to build experience and get used to identifying equal highs and equal lows. It's very simple. You're literally looking for an area with multiple highs or lows at the same level. Now what we can also see is that there is something else up here. We also have an area of equal highs. So we have 1 and 2 perfect touches of a resistance level. Then we have 3 and 4. That is 2 more additional relative equal highs. Now these are not perfect retests, but they do also add to the fact that the liquidity is situated above this level. Anyone selling at this point is going to have stops over the highs, and anyone selling at these level is going to have stops over the resistance level. So now we have 2 areas of liquidity. We have an area of liquidity just below in the form of those equal lows and all of the orders that will be waiting below. And then above, we have more equal high liquidity this time, where we know there are going to be orders, like the stop loss orders and buy stop orders waiting above. So now we've essentially formed a range with liquidity below and liquidity above. Now, let's go step by step through the process of how you would look to trade this. So first of all, if you had a selling opportunity, using the equal lows as a target would be very solid. And as you will see, the market did run through nicely, trades into that level, but does not react from the equal lows. Instead, it pushes through to the liquidity. Now, you will see that once those orders have been retested, the market begins to shift. We get this new push of strength because there's been a whole lot of take profits, stop loss orders, and sell stops executed at this level, which has kind of shifted the market, with no transactions taking place throughout this range here, and the major transactions taking place down here, which gives the market a new direction. So how can we use this now? Well, we've seen the market start to shift after trading into that area of equal lows, so it swept the lows, and now we have had a big push in momentum, indicating that we may be getting a change in the trend. So what we could do is look for buying opportunities to follow this new sense of direction and the new momentum that we are seeing in the market. So if we wanted to, we could take a trade, and what could we do here? Well, as we know, liquidity equal highs in this format is going to act as a pretty take profit target. So we could use the equal highs as a take profit target, and we would look to actually trade up from this sweep of liquidity into the new sweep of liquidity. So equal highs and equal lows are good for reaction points and reversals, and also for take profit targets. So let's see how this trade plays out. Now you can see that we traded in and retested, and the market started pushing up from this demand zone, and the market made its way up towards this equal high liquidity. Now we did start to get a slight reaction at this level. And why does this occur? Because once again new transactions have been filled as we traded above this obvious resistance level. So because we know that there is a mass number of orders up here, and because we know there is not going to be a significant amount of orders within this range, the market was able to freely move through the range. And only when it reacted to new orders did we start to get a slowdown and potential reversal in price. So that's equal high and equal low liquidity. Let's move on to trend liquidity. With trend liquidity, the concept also stands strong. Much of what we are looking for in any form of liquidity. Trend liquidity is just an area where we know there's going to be a lot of orders, and the best way to identify those is to consider the most common trading concepts used by retail traders, such as the support and resistance, and the trend lines. Because we know that these are going to have a lot of sell stops, buy stops, and stop losses all around them. The traditional way to trade a trend line is to wait for a retest and then sell, or wait for a break in the trend, and then actually look for a retest to buy from. The reason that we traders subscribe to this idea and this methodology is because we believe that a trend line forms a change in the trend. However, when we look deeper into the price action, into the actual movements of the market price, we will see that sometimes this can fail too. You can see we had a little change in the trending structure at this level, bringing this to be our high and this to be our lower low. Then we pulled back up and we formed a lower high. Then we came back down and now we formed a lower low. This is how a normal trending structure looks like. Now, that would mean, unless we were able to break above this high here, the trend wouldn't shift and we would remain bearish, regardless of whether or not we swept the trend line liquidity. A trend line break doesn't actually mean much in the way of a trend reversal, because until we break this high there hasn't actually been a change in the real trend. So with that in mind, what we can do is look to follow the trend. And then anything that happens regarding the trend line, between where we are now and an actual break of structure, simply becomes a context for liquidity. Now pay attention to this. We know then well that we are going to have sellers at this level, and that will be the first layer of liquidity. Because we know that many sellers there are going to have stop losses over the trend line. And we also know that there is going to be breakout traders, the people who are looking for the push up like this, and that's a second layer of liquidity. Because we know there's going to be buy stop orders waiting here. And the third layer of liquidity, in the context of a trend line, is from the manual execution. The buyers who are looking for a break and retest of the trend line. We also know that once we break out, there's going to be more buying here by the limit orders. So the area above the trend line becomes a pool of liquidity, essentially, but it doesn't actually indicate any changes in the trend. So what's likely to happen, and what you're going to see happen a lot, is that rather than actually conforming to the trend line, the market will push the trend line, sweep the liquidity, and then start a movement back to the downside, liquidating once again all of the buyers who buy after the breakout. So the sellers looking to sell the retest will lose, and the buyers looking to buy the breakout are also going to lose. So now how can we make use of this information and understanding, and then use it to our own advantage? First of all, don't use trend lines alone when trading with the trend. Make sure you are looking at the real price actions such as the highs and lows, and in these price numbers, I've showed you now that a trend line alone doesn't actually indicate the trend, and part of what it does is to formulate some obvious liquidity around the level. And if you don't know that, it will essentially work against you and trap you into losing positions. So in order to actually trade trend lines and trend liquidity, we need to consider the structure. And we already looked at the structure, and we know that unless this high breaks the trend, it is not reversing well. We can also see there is a supply zone here, and if you don't understand supply and demand zones, I already prepared a video that will help you on that. So we have the trending structure, and we have a supply zone, which is an area where we would look for bearish reversals. And now, by looking at this structural picture, If we were to remove the trend line for a moment, we can still clearly see the market moving in a downtrend. And that is a high probability reversal point. So without the trend line in picture, it's still an obvious area to sell. Now bringing the trend line back into it, we can also consider all of this liquidity, which are all buying liquidities. So sellers will be stopped out and will have to buy back contracts at a loss. The buy stop and buy limit traders will be buying into, providing even more buy liquidity. And what is the opposite of buy? Yes, it's a sell. Which means that if there is a huge amount of buying taking place in this level, and an institutional trader or multiple institutional participants want to get into big sales, they will first have the liquidity or conflicting orders to actually get into that position. Which means that, rather than getting a clean retest, we're likely to sweep for liquidity, and rather than getting a clean retest and push away on the other side, we are likely to sink straight back down. Now we have the bearish structure, we have a high probability reversal point, and we have all of this liquidity that institutional participants can take advantage of to get into trades, conflicting to what retail traders are looking at. So now let's watch how the market plays out. Now, as you can see, rather than reacting well to either side of this, the market swept out and stopped out all the sellers and then traded into the meaningful area for reversals, and after that sold back down, stopping out all the buyers. So, if you were to trade a trend line in a traditional sense, you would be taken advantage of by the institutional traders. But if instead you considered this in the context of liquidity and remembered all the orders that are situated around it and what they mean in the market, then you will be able to take advantage of the institutional traders by selling from the high interest supply area above the trend line, disregarding the actual trend line for trading opportunities and instead viewing it through the lens of liquidity. Now, trend liquidity can also be useful for take profit targets as well. It's not just for entries. We can also use it to add confidence to our take profit targets for our trade positions, though, in this context of using trend liquidity for targets, it is not something that we are going to be using on its own, but it definitely adds extra confidence and clarity to where the market might go. The final form of liquidity is the range liquidity, and this is the liquidity that formulates around ranges, or around swing highs and swing lows. So as you can see, when we look at this market, we can see that after it forms a low, we generally are going to get a sweep of that low, before the market then makes a meaningful reversal. So just dialing in on this smaller range, then we have a low here. In fact, we have equal lows. The market sweeps these equal lows, and then we have a push-up which sweeps these highs. So we get a sweep of the lows, followed by a reversal, and a sweep of the highs followed by a reversal to the downside. A sweep of the low here. Then we have a big push-up after the price sweeps the low here. Then after that sweep, we have a reaction, and the market started moving in greater highs. What happened here is that the market actually started the movement at this point and created this lower high, which is a great liquidity zone. And after that we had a break of structure here. The market was supposed to come back to this first liquidity immediately after the break of structure, take it out and begin making stronger highs, but instead, it started moving in ranges, taking out the secondary liquidity zones made by small retailers, kept manipulating the market and creating more liquidity, and when it was done taking out those liquidity zones, it dropped down to the first strong liquidity zone and began taking the market up. The first thing you want to observe in a ranging market is to know where the range market movement started from. You identify the first liquidity zone, which in this case is this one. Then you allow the market to do its thing. Under no circumstances should you take a trade unless the market sweeps that first liquidity zone. That first liquidity zone is your key point in the market. We wait for this because it is the final liquidity zone the market will take out before moving in strong volatility The institutional traders only focus on the bigger zones of liquidity. They are not interested in the small areas. So we will also align ourselves with them to trade like them and also make their kind of profits, even with a small account. That is what liquidity trading is all about, aligning ourselves with the bigger traders, understanding their moves, following their footprints in the market, and taking advantage of their own strategies of which they use in the market. Once your eyes have been opened to liquidity trading, you can never remain theism again, because it actually exposes all the manipulations that occurs on your chart. Liquidity trading can be combined with many strategies in the market, such as the support and resistance, supply and demand, trend lines, order blocks, and a lot more. And you can find these liquidity zones on all time frame. The bigger the time frame, the stronger the liquidity zone. Adding liquidity trading strategies to your trading strategy makes you more profits and help you to avoid a lot of unnecessary losses. But in order to make more money with liquidity trading, you must understand supply and demand trading. Earlier I talked about how supply and demand can be used to take entries and how the both of them work hand in hand. And in this video is the full course to supply and demand trading. In the comments section, tell me what you think about liquidity trading, and if you have used it before, tell me your experience. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.